Good morning, and today for Mortgage Minute Live, Tracy and I are going to be breaking down the mortgage loan estimates. So basically what this is anything, all the little bitty costs and details and all that other fun stuff that are involved in the cataclysmic event of buying or refinancing your home.
Yeah, so whether you're a first-time home buyer or just looking for a refresher, this is a really great video for you to watch through, possibly twice, and pass along and share with others.
So I did, trying to be able to break down and simplify this stuff, kind of have an idea of what you're looking at, because a lot of this stuff looks like the Matrix, for lack of a better word. And yes, we're probably aging ourselves a little bit whenever we talk about that movie, but it'll make a little bit of sense whenever you're starting to check some of that stuff out. So what we've done here, we've got a sample mortgage loan estimate. So just full disclosure, rates are for case study only. They obviously always change all the time. It's always moving up and down and all that other fun stuff. So we want to go ahead without further ado.
Yeah.
Tracy, jump in.
So this is actually a fee worksheet. This is what the old school loan estimate used to look like. Now we use something that's even more difficult to read. So for simplification purposes, this is the same data, the same figures in closing costs that would be on a loan estimate. So I always start at the very top. Just like Robbie said, the interest rate, this is just for example purposes. This is not saying, hey, this is where rates are today. So just keep that in mind. So you'll always see the prevailing interest rate for your scenario, the loan type, the loan amount, purchase price, and the terms. So keep in mind that the interest rate, whether or not you have mortgage insurance, and some of the fees that come along with it will be dependent on the loan product, whether it's conventional, FHA, RD, VA, construction, or any of our Hancock Whitney's in-house proprietary products that we have. So starting with the top left-hand corner, section 8, you'll typically see what we call your lender fees here. This is what it costs to underwrite, process, close, and coordinate the file with all the back-end support that mortgage companies are required to have when underwriting a mortgage. So these are Hancock Whitney's current basic fees on a conventional loan. If you go further down to section 803, this talks about who the third parties that we use. So you'll have appraisal, which will start anywhere from about $450 and go on up to about $550 for our market. Credit report fee for 2 borrowers, and then pulling the flood cert to see and confirm which flood zone your home is in. So just to clarify a few things, as a buyer, you're not allowed to choose your appraiser. The lender actually has to use a rotating list that will designate who the appraiser will be for your property. There are some situations and some purchases and some refinances where there's enough data in our automated underwriting systems that it may give you what's called a PIW, or a property inspection waiver, and that may negate the need for an appraisal altogether. You can still elect to get one, but one may not be necessary.
And the reason they do this on a rotating list, this has actually been in effect since 2008?
Forever.
So yeah, also
a long time,
right here. That prevents any colluding going on between mortgage loan officer, realtor, and appraiser to be able to establish,
and potentially seller,
and potentially seller, from being able to establish value. So by running it on a rotating list, it prohibits or kind of eliminates the
collusion aspect.
The collusion aspect from that side.
For sure. So I'll scroll back down, going back to flood cert. So all properties are in a flood zone. Often you'll hear people say, my property is not in a flood zone. That's not true. What they are referencing is, I'm not in a flood zone that is considered high risk, that requires flood insurance from the lender. So that's typically, for our area, flood zone X is deemed a lower risk flood zone area. We have to pull the flood cert to determine what flood zone you're in. And even if we don't require flood insurance, we always highly advise that you get it. And a lot of folks, saw that last week with the very quick downpour that we talked about on Thursday. If you want to scroll back up, we'll scoot on over to 1100. 1100 all the way down in that section through 13. Those are your title company fees, your title attorney, the company they work for. So all mortgage companies are required to use a certified title company to help in the transaction. They basically research you as the buyer, the seller, the property in question, just to ensure that there are no additional liens or errors on title or issues on the property that could cause you issues later down the road, not only for you, but for us as the investor. As the buyer, you do get to choose your title attorney, who you want to use throughout the process. So those are third-party fees that are dictated by the title company that you choose. Now you look at 1103 and 1104, lender's title insurance is always required when you finance a property. Owner's title insurance is not. We're required by law to disclose the approximate cost of owner's title insurance, but you don't have to get it. So if you decide that you don't want to get it, you just need to let your loan officer know. That's a question I defer to my title company. So if I ever have a client who asks me, should I get title insurance? That's technically not my product. So I ask that they call the title company to allow the title company to explain to them what title insurance covers. And also one thing, you get a simultaneous issue discount when you get both at the same time. So keep that in mind, that you're getting the lender's title insurance at a discount when you remove the owner's title insurance. So you may not necessarily save, in this case, $376 and maybe $100 to $200 that you save. Recording fees, this is determined by the parish where you record your mortgage and closing docs. Typically for Lafayette, for a conventional loan, it's about $210. $400 is inflated simply because the recording fee is a fee that, if it were to be higher than what we disclose, then we as the bank have to eat the difference. So we always disclose a little bit higher. And then once we get that invoice from the title company, we lower it to match the invoice for the actual recordation costs.
You got a total, and that total estimated closing cost is added up 800, 803, 1100, 1200, and 1300. Everything added up to that 4698.
Right, but we're going to keep going. Page 2.
That is not what you need to get to closing.
So top left-hand corner, section 900, days of interest, 570. Okay, what dictates the number of days is the day of the month you close. You always pay interest in advance because you always pay your mortgage in arrears. So let's say this deal closed in October. They wouldn't have a payment in October. They wouldn't have a payment in November. Their first monthly payment would be due December 1st, and they always have a 15-day grace period for their payment to be posted. So if you were to close at the first of the month, you'd have about 30 days. If you close towards the end of the month, you may only have a couple of days.
So fun fact, one of the things we hear all the time, oh man, closing costs are cheaper if you close at the end of the month. Yes, kind of. Really what you're doing is you're paying for interest, the amount of interest from the time
you
close till the end of the month. But what ends up happening, in Tracey's scenario that she was talking about before, if you close at the first, you got 30 days of interest. You got a full 30 days after that. You skip the next month, and then your payment's not due until the following. So basically all you did was just prepay interest only for the month that you closed in. So it would be a longer distance or a longer time span until you actually had to go and make your first mortgage payment. The banks are pretty smart. They've got it all figured out. They're going to get their dollars. Now, the amount of money that comes out of pocket is going to be a little bit cheaper if you close towards the end of the month. So it all works itself out.
Right. Next line, 903, is homeowners insurance premium. Okay. So on this file, these borrowers are escrowing taxes and insurance. They only put, I'm going to say 5% down. So homeowners insurance is something that you as the borrower can shop. You can use whoever you want for insurance, provided you have adequate coverage for the mortgage as per your lender. We're going to scoot over to section 1000. This is your escrow. So you're going to need anywhere from about 2 to 3 months for homeowners insurance and property taxes, depending on when you close. And this is provided you escrow. And the reason you would escrow that much, and for this example, again, if you're closing in October and you don't have a payment until December, we want to make sure, and one thing you won't see on here, we're going to make sure that we collect property taxes from the seller for January 1 through the close date. So that's a separate credit. And then you'll put in that escrow account anywhere from 2 to 3 months of property taxes, because if you're occupying the home in October, you're not paying a monthly payment in October or towards escrow. You're not paying towards escrow in November. You're paying towards escrow starting in December. So we want to make sure that when those tax bill and that insurance bill comes due the next year, you have at least accrued at least 12 months of each to be able to pay each of those bills without a shortage, unless taxes and insurance go up. Questions?
Gotcha. So fun fact, this is one of the things we hear about all the time, or what's the closing cost? What's the closing cost?
Mm-hmm.
This is part of the cost that you need to be able to get the closing, but the insurance and the escrow items are really your money to be able to pay for those insurance and the property taxes. It's not technically a closing cost. And some of them, of course, like Tracey mentioned, insurance is something that you shop. That's something that you're going to end up going, whether it's, there's a litany of different insurance companies that are out there for you to be able to shop. So this number can go up or down depending on which carrier you end up working with.
Right. Okay. In the bottom left quadrant, you'll see a total estimated monthly payment breakdown, principal and interest. That's just based on our scenario notated in this example. Homeowners insurance, it says hazard insurance, but that is a universal national language for home insurance. A lot of people look at that and they say, I don't need hazard insurance. It's home insurance. Real estate taxes, that's the property taxes for parish and city if you're within city limits. Mortgage insurance, anytime you buy a house, most of the time, and you don't put 20% down, you'll have PMI for until you reach 20% in equity, ideally, depending on how that's achieved. Mortgage insurance on a conventional loan is based on several risk factors. So the higher your credit score, the lower the mortgage insurance, the more money you put down, the lower the mortgage insurance, the lower your debt to income ratio, the lower the mortgage insurance, the lower the terms, i.e. 15, 20, 25, 30 year, the lower the mortgage insurance. So for this specific scenario, the mortgage insurance was about $83 a month. And then after a few years, it will decrease until it goes away once they reach 20% in equity. So that takes you to a total estimated monthly payment of $1,710 per month. Now, if this property is in a neighborhood that has an HOA or homeowners association, you would see the HOA dues listed here. However, that does not mean that they're escrowed. So HOA dues are always paid separately, but the reason you would see it on this loan estimate is that cost has to be factored into your debt to income ratio. So keep that in mind. So then we'll see right below that, total borrower paid closing cost. We'll scoot off to the right, and that'll break down closing cost, reserves, prepaids. And what the reserves and prepaids are your insurance premium, setting up your escrow with taxes and insurance, and the days of interest. And then it'll add everything up. It'll show you the loan amount after down payment. And all the way at the very bottom, it tells you cash from borrower. That is all of the costs associated plus the down payment. Things we would subtract out of this is if the seller were paying some closing costs, this would be subtracted out of the bottom line. Deposit that was made on the contract, this would be subtracted, along with any applicable lender credit that your lender is giving you. I do want to go all the way back up and to page 1, top left quadrant. Okay, so if you are paying points to get this rate or to get any rate, this is generally where that number is. So buyer beware. If someone is quoting you a rate that sounds really great, or even if you're just curious and really need to know, always ask and always look to see if there's any additional points or discount points, origination points, or things like that added to your loan estimate. And that's what tells you whether they are or not charging you points to get the rate. That's a conversation for another day that we may do next week, as far as buying points and how it affects the interest rate. But be aware of that. Definitely always reach out and get a second opinion from someone else if you're confused or want to shop around.
Well, and Tracey makes a great point, because sometimes the the rate sounds good to be true. And in our world, if it's too good to be true, it probably is. So there's usually a reason that something sounds too good to be true. So the devil's always in the details whenever you're looking at some of these things. So you got questions at the end of the day. One thing that she's always done with our clients for years and years and years is if it's that great of a deal, she'll tell you to go with it. So we'll help you walk through and make sure that you're making a wise financial decision to be able to make that move.
Right. So just always make sure whenever you're getting a quote for a purchase or a refinance, get a breakdown, a loan estimate, whatever they want to call it, basically a list of all of the numbers that are involved, and take a good hard look at it. And if you have any questions, you can reach out to me.
Last but not least, one of the last things I wanted to make sure that when you are comparing those numbers, we're going to jump back up on here. All of these numbers need to kind of keep an eye on most of them, not the bottom right-hand corner of what you need. That's actually one of the indicators of what you need to be able to do. But making sure that your escrows should be equal, or at least have an accurate number in them. Like you've actually had a homeowner's insurance quote and you actually pulled the property tax information on there. Because
I see so many mistakes, especially from lenders who aren't physically located in our market, who will lowball taxes, who will lowball insurance. They have no idea about flood zone. So just be cautious of that. Also, if you're getting multiple quotes, get them at the exact same time on the exact same day, because
rates change
at
every day.
any moment when the market is open, rates could shift. And if you're getting a quote at 11 a.m. on a Monday and then get another quote at 2 o'clock on a Tuesday, they could be two completely different quotes. So
lots of things happen. So of course, as always, if you're interested in finding out a little bit more about what that happens to look like, where can they find you?
You can give me an email, tracy.lasayer@hancockwhitney.com.
You guys make it a great day, and we will see you next week.